Hello everyone, how are you? I hope all of you are doing really good. So welcome to another session of financial management theory part, and we have been discussing about our chapter, that is the sources of finance or the types of financing, that whatever the money you require to run a business, how are you going to arrange that money, whether it is through equity share capital, through preference share capital, through retained earnings, through debt. That is what we have discussed, right? So before we continue with this, I request all my YouTube community to guys please support and share about these lectures, because nobody else is going to share these Telegram owners and all those things. Those people, I do not expect anything from them, right? They have never shared anything. I don't know, they are getting money or something separate thing, right? So it's all up to you guys if you people can support, because what I have observed in the last few months, I can say, in the last some time, that there has been a constant decline. So ultimately, if this is the kind of support we continue to get, then ultimately we'll close this channel. That's for sure, right? Because we have done so much of work on this, and if you people are not going to support ultimately, then what is the fun of keeping it? There is no fun, right? Even we don't feel the energy to continue then. Okay. So let's continue. Why even I would have stopped this chapter also, because there is no response, absolutely no response, right, on this chapter I'm getting. But why I'm doing is because there is a few people who have purchased the books and who are following the YouTube lectures. For those people I'm going to complete this particular chapter, that is types of financing, because that was the promise and that I had to keep. Okay, let's continue. Let's see how many of you support, or how many of you try to share and everything. But it's kind of disappointing that after putting in so much of efforts, there is the kind of response that is being there anyhow. So in the last lecture we have done about equity share capital, preference share capital, we discussed about retained earnings, and then we discussed about debt. Now there is another instrument, that is bonds. What are the bonds? The bonds are also a long-term source of finance, but yes, some bonds can be other sources of the finance. We'll study there also some kind of bonds. Now this is again a very similar thing to debenture, very similar. The bond is a fixed income security created to raise a fund. Debenture is also, the debt is also a fixed income, that is also a fixed income from the point of view of investor, right? So this fixed income is from the point of view of investor, right? Created to raise fund. The bonds can be raised through public issue or through private placement. Private placement is you issue to a specific people who you know, and you do not issue in the public. General public cannot subscribe to the bonds, right? So types of bonds, one is the callable bonds, and one is the kind of puttable bonds. What are the callable bonds? A callable bond has a call option which gives the issuer, that is the company who has issued the bonds, they have the call option to redeem the bonds before maturity at a predetermined price known as the call price. So they can, if they have issued the bond for 10 years, they can redeem it after 7 years, right, at a predetermined price. Obviously it will be at a premium. Why it will be at a premium? Why it will be at a premium? For example, I have purchased a bond from a company X, right? It is a 10-year bond. That means if I have invested in that company's bonds, I will be getting the income for 10 years. Now, if after 7 years, the company says, please give my bond back, I am losing out on income of 3 years. So the company says, we'll compensate you, we will pay the bond price, we will redeem at a premium so that you do not face a loss of 3 years. That is why normally it is at a premium. Then the puttable bonds. The puttable bond gives the investor an option. When we talk about the callable bonds, here the call option is with the issuer of the bond. The puttable option is with the investor. The investor says, I want to sell the bond back to you, right? Has a put option, that is the right to sell the bond back to the company before maturity. Now I have purchased the bond of a company which is for 10 years, and after 7 years, sir, I want to sell the bond, please give my money. So that is what, that is a puttable bond. Clear? So these are the two things, callable bond and the puttable bond. Callable bond is the option with the issuer, puttable bond is the option with the investor. Now there are some various types of bonds and their features they have given. And sir, in the examination, what we can get on this, sir, we can get a short note, right? We can get a short notes on these. The first one is the foreign currency convertible bonds, FCCB. This bond comes at a very low rate of interest, right? The rate of interest is quite low. The advantage to the issuer is that the issuer can get the foreign currency at a very low cost. What is the cost to the issuer? The cost is this interest rate that the issuer has to pay, right? And in return, they will get what? They will get the foreign currency. But the risk, what is the risk? That when you are to redeem that bond, you will need that amount of foreign currency, right? And what if you are not, the foreign currency is not available with you at the time of redemption of the bond? So that is kind of a risk there. That is known as foreign currency convertible bond, FCCB. The risk is that in case the bond has to be redeemed on the date of maturity, the issuer has to make the payment, and at that time the issuer may not have the money, right? After that, we have plain vanilla bond. What is a plain vanilla bond? The issuer would pay the principal amount along with the interest rate from time to time. You will keep on redeeming. You will be paying the principal amount also along with the interest rate. This type of bond would not have any option. Any option means what can be the options with the bond? Any option means the convertibility will not be there. Right, convertibility will not be there. You cannot convert a bond into a share. You cannot convert a short-term bond into a long-term bond. No, right? Callability or the putability will not be there. Right, callability will not be there. So this is kind of a bond, plain vanilla bond. This is kind of a bond which will have no options, right? This bond can be issued in the form of discounted bond. Discounted bond means if the face value of the bond is 100 rupees, you are issuing at issue prices, you are issuing at 90 rupees, right? It is a discounted bond. Or can be issued in the form of a coupon bearing bond, that is a fixed coupon rate. That is a fixed coupon rate, that this bond, on this bond you will get 5% or 7%, you will get a fixed coupon rate, right? So this is how the bond can be issued. That is a plain vanilla bond in which the principal amount along with the interest is to be repaid, and there is no option, no callability, no convertibility, nothing is there. No options are available for the bond. It will be available for the time period, right? It can be issued at a discount and it can carry a fixed coupon rate that, okay, this is the the interest that you will be getting. This is the income that the investor will be getting. The next one is convertible floating rate notes, FRN. A convertible FRN is issued by giving its holder an option to convert it into a longer term debt security with a specified coupon rate. Now what happens, sir? The company issued this bond for, let's say, 1 year or 2 years. Now they will give the option to the holder to convert it into a long-term debt security. Convert it for 7 years, for 10 years, convert it into a debt, and with a fixed coupon rate, 7%, 8%, 10%, whatever the coupon rate is decided, with a specified interest rate. Specified coupon means the specified interest rate, right? This can be converted into a long-term debt security, right? It protects an investor against the falling interest rate. That the investor, here you have fixed the interest rate, let's say at 7%. The market interest rate in the future, let's say, is 4%. Now the investor will get 7% income. The investor is safeguarded, right, by having it at a fixed particular rate. Otherwise, what happen in the case of bonds, the interest rate or the coupon rate might not be fixed. It might be a floating rate, right? That whatever the rate is prevalent in the market, that rate will be paid. That is, for example, 4%, 5%, whatever is the coupon rate that is prevailing in the market, that will be paid to the investor. But in case of convertible FRN, what they say is we will convert it into a fixed rate long-term debt. You are getting a fixed rate. So tomorrow in the market, if the rate falls, you are getting a 7% return, right? The long-term debt security can be sold in the market and the investor can earn the profit. Now this long-term debt, the investor can sell it in the market, he can go to the market, and if there is a profit that he can earn, right? The profit is the capital gain basically, right? If he has let's say invested 100 rupees in the bond that is converted into a debt, right? He gets a debenture, he goes to the market, sell it for 200. So here this 100 rupees is what? This is a capital gain for the person, right? Capital gain otherwise is not applicable directly to FRN, but if it is converted, go to the market, sell it, and then you can go for the profits. The next one is the drop lock bond. Drop lock bond is what? It is a floating rate note with a normal floating rate. Floating rate means the rate which is not fixed, the rate which changes with the market rate, right? Today it is 4%, you will get 4%. Tomorrow if it is 5%, you will get 5%, right? So it is a floating rate. The floating rate bond would be automatically converted into a fixed rate bond if the interest rate falls below a predetermined level, right? So if the interest rate, for example, at the time of issue of the bond by the company has given the clear terms and conditions that otherwise it will be a floating rate. It can be today, it can be 7%, tomorrow it can be 8%, next day it can be 6%. Right? But the company says that if this coupon rate, the market rate falls below 3%, then we will convert this floating bond into a fixed bond, right? We will convert this floating bond into a fixed bond. Clear? Now, once it has been converted into a fixed rate bond, then it will stay as a fixed rate bond only. Then it will again not be converted into a floating rate. He says the new fixed rate stays till the drop lock bond reaches its maturity. The difference between the convertible floating rate note and the drop lock bond is that the former is a long option structure and the latter one is a short option structure. So please remember this point, that what is the difference between this convertible FRN, that here the conversion is taking for a long period of time and here it might be for a short period of time, right? Because for example, the bond is, let's say, for 5 years, right? For 5 years the bond is there, and after 4 years this coupon rate falls below 3%, right? So for 1 year it will be converted into a fixed rate bond. So it can be for a short period of time. Whereas this convertible floating rate, it is for a long period of time because it is being converted into a long-term debt, right? It is being converted into a 7-year, 10-year debt. So this is a drop lock bond, that if the floating rate drops, the lower than the level, predetermined level, then it will automatically be converted into a fixed rate, right? Then variable rate demand obligations. Variable rate demand obligations, a normal floating rate note with a nominal maturity, right? Neither too long a maturity period, 10 years, 15 years, no, and not a too short. The holder of the floating rate note can sell the obligation back to the trustee at par plus the accrued interest. So the holder of this floating rate note, they can return the bond, right, and they can get their money back at par plus whatever the interest is accrued for the period that was being held, right? It is a nominal maturity. It gives the investor an option to exit, so it is more liquid than the normal FRN. Normal FRN, you cannot sell it back like that, right? So in this case you have a puttable option. Basically what you have is, in this particular case, you have a puttable option. That is what is there. Puttable option is there, that you can sell back this bond and you will get your money back at par plus whatever the interest is there. So it is basically more liquid. In case you need money, sell back the bond. Then yield curve note is there. What is a yield curve note? The yield curve note is a structured debt security, right, in which there will be a fixed coupon rate. The yield increases when the prevailing interest rate declines, right? So you are getting a fixed rate. You are getting a fixed rate, that is 7%. Now, if the market interest rate declines, for example, the market interest rate falls to 4%, but you will be getting 7%, your yield will increase, right? And the yield decreases when the prevailing interest rate increases. Now, if the prevailing interest rate increases to 10%, you will be getting 7%, sir, because it is a structured debt in which everything is properly defined, structured, given. So in case now in the second case, if the interest rate increases, your yield will decrease. Now yield means the return. This is used to hedge the interest rate, right? So if there are any losses that you might occur due to the fall in the interest rate, you are safeguarded against that, right? It is the hedging approach. This works like the inverse floater. Now Eurobond, just remember this in inverse floater, right? For MCQ purpose also, there are few things that you need to remember, right? Inverse floater means this is not a kind of a floater, because in the floater what we say is that it is directly whatever the rate is, you will be charged that, right? But here we are saying that with the change in the rate, your yield will change, right? If the interest rate declines, your yield increases. So there is an inverse relationship between the floating rate and the yield, and here we are talking about the yield. Inverse floater here means the inverse relationship between yield and interest rate. Okay, the next one is Eurobond. The Eurobonds are issued or traded in a country using a currency other than the one in which the bond is denominated, right? So let's say the Eurobonds are issued in a country, they are being issued in India, right? But they will not be denominated in INR. They will not be issued in INR, right? They will be issued in some other currency, in the US dollar or some other currency they will be issued, right? This means that the bond uses a certain currency but operates outside the jurisdiction of the central bank that issues the currency. Right now it is outside the jurisdiction of RBI, because RBI is going to issue in INR. This bond has been denominated in some other currency now. Denominated in INR, issued in some other currency, right? The Eurobonds are issued by multinational corporations. For example, a British company may issue a Eurobond in Germany, denominating it in US dollar, right? They may issue it in Germany, denominated in US dollars. It is important to note that the term has nothing to do with the euros, and the prefix euro is more generally to refer to deposit outside the jurisdiction of the domestic central bank, because we are using some other currency to issue or to denominate that particular bond. So that is a euro bond. Clear? This is important. Short note on the euro bond can be asked. Then these were the foreign bonds. Now there are Indian bonds also, and in the Indian bonds, this one is important, that is a Masala Bond. Masala means the spices, right? Masala means the spice bond is an Indian name used for rupee denominated bond that Indian corporate borrowers can sell to the investors in the overseas market. So what is this kind of a bond? This bond has a feature that this is being issued in INR in the foreign market, not in India. Right? This is the bond that is issued outside India but denominated in the Indian currency. Right? These bonds are issued outside India but denominated in Indian rupees. NTPC raised 2,000 crore via Masala bonds for its capital expenditure in the year 2016. So you have to remember the main points here. Right? Next one is the municipal bonds are used to finance the urban infrastructure, are increasingly evident in India. The Ahmedabad municipal, now this is not important. Municipal bonds are to infrastructure for the purpose of urban infrastructure, maybe the highways, the malls and everything, right? For that the companies can issue the bonds, right? Government or the treasury bonds, these are the safest bonds. Government or treasury bonds are the bonds issued by the government of India, Reserve Bank of India, or any state government or any other government department, right? These are the safest bonds because these are the guaranteed rate of return, and these are the risk-free bonds. What we call them? We call them as the risk-free bonds. Risk-free bonds, right? Some other bonds are included in the other source of financing. We'll take up later on, okay? Now, a loan from financial institutions, there are various financial institutions in the country. It can be the banks, it can be the other institutions who are providing you the money, and they will charge some interest and something against that, right? So there are various. Industrial Finance Corporation of India is there, State Financial Corporation is there, Industrial Development Bank is there, National Industrial Development Corporation. So LIC is there, UTI is there, IRBI is there, Industrial Reconstruction Bank of India. Nothing, you don't have to remember this. Forget about it, right? Then is the loan from the commercial banks. Now, one of the major roles of the commercial banks is giving the loans to the people, isn't it? One of the major roles of the commercial bank is giving the loans. Now, earlier they say they were providing only the short-term loans, but now they have started to provide the long-term loans also. At the same time, they are providing the long-term funding for the working capital requirement also, right? Maybe for 5 years, for 6 years, if you require a working capital loan, the commercial banks will provide you with that also, right? But one thing that you have to remember here is that when they are providing the long-term funding for working capital, they are providing it for permanent working capital. They are not going to provide it for the temporary working capital, because temporary working capital is impacted by the seasonal fluctuations, right? And the commercial banks are not going to take a risk with regard to that, right? It is the funding of that portion of working capital which is always required. That is the minimum level and is not impacted by the seasonal requirement of the company. Now, that means it is the funding for the permanent working capital. For permanent working capital and not for temporary working capital. Clear? So this we have already studied in the chapter of working capital, isn't it? Now there is a small term that is bridge financing. What is a bridge financing? What is a bridge financing? Let's say there is Mr. X, right, who has applied to a financial institution, right? Financial institution, let's take up any, let's say the Union Trust of India. Now he has applied for to the Union Trust of India for a loan of, let's say, rupees 1 crore. He has applied for that. Now this application procedure, the whole procedure of applying for the loan and getting the disbursement will take time, right? Now the UTI says the disbursement of it, the disbursement of the loan, the processing of the loan, right, will take approximately, let's say, 2 months. Now Mr. X says, sir, 2 months is too much of a time. I want to start with my business. I need some money out of it. If not 1 crore, give me 10 lakhs, sir. UTI says, no, we can't give like that. We will disburse the full loan after 2 months. Now Mr. X in the meantime wants to start their business, want to start their work somehow. So what will Mr. X do? Mr. X will go to, let's say Mr. X goes to HDFC Bank and ask for a loan of let's say rupees 10 lakhs so that he can start with the business, right? And this is known as the bridge financing. This is known as bridge financing. That is, you take a loan for the time period till the time you get this disbursement of the major loan that you have applied with the financial institution, right? This is a short term period. This is a short period loan. This is a short period financing, right? And sir, how will you pay back? How will you pay back, sir? As soon as you will get this disbursement of 1 crore, you will pay this 10 lakh out of this disbursement. Simple, right? When you get this after 2 months, when you are going to get 1 crore from the UTI, you will return this 10 lakh to HDFC. That is why we are saying it is a short period financing. It is what? It is a short period financing. This is what is the bridge finance, that it is a short period because of refers to the loans taken by the company normally from the commercial banks for a short period because of the pending disbursements of the loan sanctioned by financial institutions, right? So this is a financial institution. This is a financial institution. This is a company, right? And this is what? This is a commercial bank. This is a commercial bank, right? So that is what? Clear? So till the time they get the disbursement from the financial institution, they will take a loan from commercial bank. So it is for a short period of time. It is short term in nature, but important step in the facilitation of the long term loan. It is being discussed along with the long term sources. It takes time for the financial institution to disburse the loans. However, once the loans are approved, it is all that is given. The bridge loans are repaid or adjusted out of the term loans as and when disbursed by the concerned institution, that when UTI will disburse the loan of 1 CR, this 10 lakh loans will be paid back, right? And generally the rate of interest on the bridge financing is higher as compared to that of the term loan. That is obvious because you are going to get it for a short period of time, right? So HDFC will charge a higher rate of interest. Short period of time, high rate of interest will be there. So these are the few features. High rate of interest will be there. Clear, sir? So this is about the bridge financing, and that's it. In the next video, we will take up venture capital financing, then we will take up debt securitization, the few topics, right? Easy ones. And then we have the lease, the types of leases there, operating lease and a financial lease is there, right? And okay, so these few things we'll take up in the next video. But for now, I'll request every one of you to please revise whatever we have done. The types of bonds and this bridge financing part specifically is important, because on this bridge financing there has been the short note which has already been asked, and in the future also it can be asked, a short note on the bridge financing, a very important topic, and you need to remember the basic thing and write it in your own language. That will be absolutely fine, right? So see you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.